And Liam, of course, we had both the Chancellor and the Governor of the Bank of England at this important Mansion House sort of dinner last night and warning about the dangers of wage inflation. And there we are the day after they've been proved right.
We did indeed hear from both the Chancellor and the Governor of the Bank of England, Andrew Bailey, last night at the Mansion House, doing a kind of double act, a display of unity. The Bank of England, of course, under enormous pressure because the inflation target in this country set by the Treasury is 2%, and our inflation on the latest numbers is still 8.7%. And let's have a look at those wage numbers that you mentioned, Mark and Pip. Ordinarily, the fact that wages are going up strongly would be a cause of celebration, but there are two reasons why they aren't celebrating, because they're going up by less than the rate of inflation, and there's concern that will lead to more inflation still. So what the numbers show is that between March and May, those 3 months compared to the same 3 months in 2022, private sector pay was up 7.7%. 4/5 of us work in the private sector. That's the fastest rate of increase on record. Public sector pay, the 20% of people working in the public sector, schools, healthcare and so on, their pay went up 5.8%, and that's the fastest since 2001. And when he stood up at the Mansion House, a big ceremonial hall in the City of London opposite the Bank of England, Bank Governor Andrew Bailey said that rates of pay increase at this level, even though they're less than inflation, even though they're going down in real terms, are, quotes, simply not compatible with inflation currently for almost 5 times target. And that's why the chances are, given these wage numbers, unfortunately, when the Bank of England's Monetary Policy Committee next meets to set interest rates in early August, they're likely to put rates up again from 5% where they currently are.
And of course, as we've indicated, the gap, if you like, between the private and public sector pay deals and salaries as well, because we've got the additional aspect now of this independent pay review bodies coming in on teachers, on health services and so on. You know, they're talking about, 6.5% for the teachers, yet more pressure via the public service as well as the private sector.
We've got an awful lot of the public sector on strike, haven't we? A lot of public sector unions, they became, certainly their leadership, more militant during lockdown. And I would say, Mark, being realistic, that 5.8% public sector pay increase, that's on average. A lot of the public sector workers who are on strike, they're going to want even more than that. They're going to want a number that's closer to the rate of inflation, which is currently 8.7%. There is a silver lining here. The silver lining is, as the Bank of England Governor Andrew Bailey said last night, and I do agree with him on this, he thinks that inflation will, when it does start to fall, it will start falling rapidly. So we got the next numbers out coming in a few weeks' time. I do think inflation is going to start falling, but still, we've got this gap between inflation, 8.7%, where the government is setting these wage bargaining outcomes for the public sector. Those two have to come together if we're going to be able to get beyond these really damaging public sector strikes that, of course, are causing a lot of the public a lot of hassle during these summer months.
Let's also talk mortgages, because there's yet more pressure on homeowners. 2-year fixed mortgage rates have risen to the highest level since the 2008 financial crisis. A typical 2-year deal has risen to 6.66%.
It's unbelievable, Pip. Just a few months ago, you could get a 2-year fixed rate mortgage for 2% or 3%, maybe 4%. Now, as you say, on average, it's 6.6% plus. And for a lot of people with higher loans to value, borrowing a lot of money, who can't put down a big deposit, first-time buyers, particularly those who aren't lucky enough to be able to rely on the bank of mum and dad, as over half of first-time buyers are now here in London and the South East. Around a third of first-time buyers across the country. If you can't rely on extra cash from your money, you're going to be paying a lot more than 6.6% for that first mortgage, because your loan to value will be higher. This is why house prices are coming down, because people can't afford to put in big bids, because they can't afford the mortgage payments to finance them. And this is the difficulty for first-time buyers, kids trying to get on the housing ladder. Even if house prices come down a bit, and they are now coming down a bit, if you have to pay more to borrow a certain amount of money because interest rates are higher, It doesn't make houses more affordable. This is a major problem. This conundrum of interest rates, inflation, mortgage costs. This is going to dominate politics between now and the run-up to the next general election next autumn. In the end, in my view, economics wins.
Indeed, and headaches for those politicians behind you, of course, in Westminster as a result of all that. Liam, thank you very much indeed for updating us.